Last quarter, one of the country's most disciplined funds increased a single position by 1,200%. The stock they were buying on the chart looks broken. The story isn't on the chart. The story is in the filing. This is GreenCandle. 7 filings worth reading from the last quarter. First signal, GE Aerospace. The loudest 13F filing on the list. 3 of the most disciplined funds in the country leaned hard into this name in the same quarter. The position increases are on screen, and they're not subtle. 3 independent funds, same direction, same quarter, against the price action. That's not noise. The reason it's worth reading is the chart on this stock has been broken for months, down 18% from the high. Most retail looks at the chart and walks away. The filings did the opposite. The story underneath is GE Aerospace as the engine half of what used to be General Electric, CFM LEAP. A services annuity that compounds for decades. The thesis isn't broken, the tape is early. Disciplined money positions into early tape, not late. What I'm watching is the entry zone on screen. Currently sits a few percent above. If the tape gives that back, the disclosed positioning becomes actionable. Second signal, Baker Hughes. What a confirmed post-print breakout actually looks like. Q1 reported. Industrial orders hit a record. The post-print tape, heavy volume, twice the average, breakout to a fresh 52-week high. The stock held. The numbers are on screen. Worth reading. The street's price targets sit 14% below where the stock trades today. That's not analysts being wrong. That's analysts being mechanically behind a re-rating already priced in. The story underneath is a re-rating from oilfield services toward AI power infrastructure. 3 consecutive quarters of record industrial orders is a step function in demand for power island contracts. The same multiple is expensive on the old framing and cheap on the new one. The re-rating is the trade. Heavy volume on a fresh high day after a fundamental beat is institutional accumulation, not retail FOMO. The volume itself is the leading indicator. The structural support, 3 decades of dividend growth underneath, is already in place. What I'm watching is the gap fill zone on screen. Currently sits about 11% above. Q2 print in July is the next test. A 4th consecutive record orders quarter would be confirmatory. Third signal, NextEra Energy. The structural floor under this entire slate. 3 decades of consecutive dividend increases means every dollar of fresh inflow into income, ETFs, becomes mechanical buying pressure on this stock. The flow isn't disclosed. It's required. Here's what else is in the file. The unregulated subsidiary added a record amount of Q1 backlog with hyperscalers as the visible counterparties. Total backlog represents 5+ years of revenue conversion. Utilities don't usually carry this kind of growth tailwind. The story underneath is a regulated utility, half of Florida, combined with secular AI power growth through the unregulated arm. The Florida monopoly is the floor. The hyperscaler agreements are the upside. Most utilities have one or the other. This one has both. Worth flagging, a nuclear restart in Iowa, NRC approval dependent, multi-year horizon. If it lands on schedule, NextEra becomes the largest U.S. restart nuclear operator. If it slips, deferred, not destroyed. The option doesn't require near-term resolution. What I'm watching is the entry zone on screen, currently sits a few percent above. Consensus targets have caught up to spot. 4th signal, ATI, the largest capital allocation move on the list. Management just authorized a buyback at roughly 5 to 6% of the entire market cap. There's no dividend on this stock. Free cash goes to repurchase, or CapEx. Buybacks at this scale, post-deleveraging, aren't promotional. The signal is management knows what's coming and would rather own more of it. When the use of capital is repurchased at this magnitude, they're voting with the balance sheet. The story underneath is sole source. ATI is sole source on 5 of 7 hot section jet engine alloys. The certification process for replacement suppliers takes 5 to 10 years. The major engine OEMs have ATI contracted through the 2030s and 2040s. This is the rare case where customer concentration risk is genuinely low. Defense missile alloys are up over 100% year over year. Trump priorities, Middle East restocking, post-Ukraine replenishment. The aerospace business is the base. Defense alloys are the surprise upside. What I'm watching is the prior support level on screen sits about 5% below current. Q1 print in 4 days. Cleanest entry is post-print, not pre-print. 5th signal, nVent Electric, a short cover that's already partly played. Short interest dropped almost 30% over the quarter. The shorts saw the same backlog data the longs did and started covering. The squeeze isn't theoretical. Here's what they're seeing. Backlog equal to roughly 60% of trailing 12-month sales. The picks and shovels position on AI data center electrical is finally being recognized. The stock is up over 170% in a year. Late recognition tape. Worth noting, the structural caveat. Return on invested capital sits below cost of capital. Incremental returns are below the line. The buyback offsets some of it, but ROIC needs to move above WACC for the long-term thesis. The story underneath is the unsexy backbone of AI compute. Tuck-in acquisitions added utility-grade defensibility. Hyperscaler plus colocation customer mix. Q1 backlog adds are the leading indicator on the post-print tape. What I'm watching is the May 1st print, 5 days out. Anything above the high end of the EPS guide supports a guide raise. 6th signal, Corning. A contrarian setup with one bank dissenting. One major broker downgraded. The accumulation headlines say the opposite. The disagreement itself is the signal. Here's what the bulls are reading. A $6 billion multi-year optical fiber contract with one of the largest hyperscalers. Cable construction starts this month, the operational proof point. Multi-year contracted revenue is now visible regardless of AI CapEx sentiment. Here's what the dissent reads. Forward PE around 50 times next 12-month earnings is rich. That's the bear case anchor. The dissent isn't unreasonable, it's just lonely. One downgrade against broad accumulation is the textbook contrarian setup. The story underneath is a re-rating from specialty glass and display toward AI optical infrastructure with display ballots. Display is the regulated utility floor. Investors who wouldn't pay 50 times for a pure optical play will pay it on a hybrid. That's the structural reason the multiple holds. Q1 print is in 2 days. Optical at or above guide, and the dissent gets discredited. Optical disappoints and the multiple compresses. Entry zone on screen sits well below current. Wait for post-print is the disciplined call. 7th signal, Lam Research, the cleanest possible setup in the slate. The highest performing quant fund in history opened a new position last quarter. When that fund moves, you pay attention to where the cycle is. Here's why it matters. Of 37 names in the universe scanned, Lam is the only one with every framework component scoring above 8.5. Fundamentals, momentum, volume, swing, comparator, forward catalysts, every single one. When every framework picks the same name, the name has earned its position. Earnings already reported. Beat. Stock printed a fresh 52-week high on confirming volume. Consensus targets sit below spot. The revision cycle is the next visible flow tailwind. One of only 2 names in the slate without an earnings overhang. The story underneath is silicon capital equipment at the intersection of every AI inflection. HBM ramped through 2027, gate-all-around at the leading foundries. The installed base annuity provides recurring revenue ballast. Lam has the largest installed base of any semi-cap. Memory cycle isn't the swing factor anymore. Foundry and logic became the structural anchor. What I'm watching is the 50-day moving average support on screen currently sits about 7% above. No print binary, no structural overhang. If you take one name from this video, this is the one. 7 companies, 7 sets of disclosed positioning, a 13F triple stack on a broken chart, a post-print breakout the street hasn't caught up to, a dividend streak income flows have to keep buying, a buyback at 5% of market cap, a short cover already partly played, a contrarian setup with one dissent, a quant fund opening into the cleanest setup. None of these are the same trade. 4 are already cleared and actionable now. 3 have prints inside a single week, size smaller, positioned for after the report. None of them are in the headlines. All of them are in the public record. Anyone can have an opinion on GE. Northwestern Mutual had to file theirs. This is GreenCandle. The filings are the filings. The opinions are everything else. One last note. Nothing here is financial advice. Disclosed positioning data is what it is. 13Fs lag. Short interest reports lag. Buybacks don't guarantee execution. Stories change. Do your own research before any of these becomes a decision. If reading the filings is useful to you, subscribe. Next quarter's 13Fs file in the second half of May. I'll post the readout. Drop a comment. Which filing made you look twice?